You know, in the world of investing, some of the best companies are the ones hiding in plain sight. So today, we're going to open up the institutional dossier on Aether Industries. We're going to apply a really strict framework to answer just one critical question. Is this thing a genuine long-term compounder, or is it just another cyclical trap?
All right, so let's set the stage. What's the situation here? Well, when most investors, maybe even you, look at Aether, you see specialty chemical company. And your brain immediately puts it in a box, right? A familiar and, let's be honest, often dangerous box. You start thinking about cyclical demand, brutal price wars with China, and margins that are all over the place. But is that really what's going on here? Is that the whole story?
And right there, that's the core conflict. It's a real puzzle. Because on one side, you've got this default commodity thinking. You're expecting price wars. You're expecting customers who'll leave you for a penny. But then you look at Aether's actual results, and the reality is completely different. We're talking about stable, high margins, customers who are incredibly sticky, and this quiet but very real pricing power. That huge disconnect, well, that's the puzzle we're here to solve today.
So, how do we solve it? Well, that brings us to Section 1, Chemistry, not Commodities. We're going to dive in and break down what Aether actually does to uncover the real engine behind these numbers. And I'll tell you, this is exactly where most people get the story wrong.
Okay, let's get right to the core idea here. It's all about something called process chemistry. See, Aether's real competitive advantage, its moat, isn't the chemical molecule it sells. That can eventually be copied. The real secret sauce is in how they make that molecule. Think of it like a master chef's recipe. The ingredients, the molecule, might be known, but the step-by-step process, the technique to get it perfect every single time with the right purity and consistency, that's the part that's incredibly painful and expensive for anyone else to replicate.
Let me put it as simply as I can. Molecules can be copied. Processes create lock-in. Anyone can try to make the what, but mastering the how, making it perfectly, efficiently, batch after batch after batch, that's what locks customers in. That is the real moat.
And you know, this moat isn't built overnight. It's built over a long, long time. Just look at this customer qualification cycle. For a big pharma or agrochemical client, choosing Aether isn't like buying paper clips. It's a multi-year commitment. We're talking months of lab trials, then pilot batches, then a year or more of stability testing, and finally getting regulatory approval. After going through all that, once Aether is locked into their supply chain, the cost and the sheer risk of switching to someone new, it's just massive.
And that brings us to this incredibly powerful idea. In pharma and agrochemicals, a failed batch costs more than a price increase. Just think about that. For Aether's customers, the cost of one bad batch could be catastrophic. We're talking recalls, huge fines, and brand damage that takes years to repair. So the potential savings from a slightly cheaper supplier, it's just not worth the risk. And that, right there, is where Aether gets its silent but incredibly powerful pricing power.
All right, so that's the story. It sounds great, right? But a great story is just a story. The numbers have to back it up. So that brings us to Section 2, the cash flow engine. Because in this industry, the financials are the ultimate lie detector test. It's the show me the money moment.
And here's the one non-negotiable rule you have to remember for specialty chemicals. If the reported earnings, the EBITDA, don't actually turn into cold, hard cash, then the margins are just a story. They're not a real business. If all that profit is just getting stuck in unsold inventory or bills customers haven't paid, the model is broken, period. So let's put Aether to that test. So this table right here, this is our lie detector test. And what does it show? We see that the cash flow from operations, that's the actual cash the business is generating, it tracks the reported EBITDA growth almost perfectly over the long run. Now you'll see a temporary dip in the middle, but that's totally explainable. That's just them investing in new plants to fuel future growth. It's not a sign of trouble. The key takeaway is there's no permanent leakage here. The cash is real. It passes the test. And this financial discipline, it shows up everywhere on the balance sheet. Look at the receivables, the money they're owed. It's controlled, it's structural. They're not desperately extending credit just to make a sale. Their inventory, it's built because they have committed customer orders, not because they're gambling on future demand. And their debt, it's used for one thing, growth, not for survival. This, my friends, is what a healthy balance sheet looks like.
So what's the end result of all this? It's simply superior capital efficiency. This chart shows something called return on capital employed, or ROCE. It sounds complicated, but it's just a simple question. For every dollar the company invests back into its business, how much profit does it spit out? And as you can see, Aether consistently generates returns well over 25%, while its average competitor is stuck below 15%. This proves that their high-quality business model is absolutely no accident. It's by design.
Okay, so we've got a great business model, and we've got the financials to prove it. But that brings us to the really crucial third section, management and key risks. Because, let's be real, even the best business in the world can be run into the ground by poor leadership. At the end of the day, how they allocate capital is everything.
What's so interesting about Aether's management is that you can almost define them by what they don't do. They're operators, not gamblers. You don't see them making flashy overseas acquisitions. They're not chasing whatever chemical is hot this year. They're not loading up the balance sheet with aggressive debt. Instead, their focus is relentless. They stick to what works, building these highly specialized plants, but only when they have clear visibility on customer demand. And with promoters holding around 74%, you better believe they have their own skin in the game.
But look, no investment is a sure thing. So now we have to completely shift our mindset. It's time to stop admiring how great the business is and start looking for the dangers. We need to identify the kill switches, the specific risks that could permanently destroy capital and wreck this entire investment thesis.
And when you boil it all down, there are really only 4 risks that truly matter. First, a major process or quality failure. That's existential. It could erase a decade of customer trust in an instant. Second, what if their CapEx runs way ahead of demand? That would cause their return on capital to collapse. Third, a hidden concentration risk. If they become too dependent on any single molecule, they lose pricing power. And finally, a change in the promoter's behavior. That's a self-inflicted failure. These 4 things, this is the dashboard you need to watch.
All right, we've looked at the chemistry, we've stress-tested the cash flow, we've sized up the management, and we've identified the kill switches. That brings us to our final section, the final verdict. It's time to bring it all together and make a call.
So, the verdict from the dossier is in, and it is clear. Approved. Aether Industries absolutely fits the profile of a high-quality, defensible compounder. But, and this is a really important but, you have to be sensitive about your entry price. The market knows this is a good company, so an investor has to be disciplined on valuation.
Now, how would an institution actually deploy capital here? Well, they almost never go all in at once. It's a methodical process. The logic is pretty simple. You establish a base position today, maybe about 30%. Then you patiently wait to add more. Maybe during a broad sell-off in the chemical sector, or as the company proves itself by hitting new milestones. This step-by-step approach is all about managing risk. The risk of valuation, the risk of the market cycle, and the risk of execution.
And that really brings us to the most important part, the required mindset. This is not a trade you make for the next quarter or even the next year. An investment like this has an expected holding period of 10 to 15 years. The real edge you have as an investor here is what we call time arbitrage. It's the patience to hold for a decade or more and just let that deep competitive moat do its work, quietly compounding value long after all the short-term noise has faded away. So, that really leaves us with one final critical question for you to ask yourself. When you look at a business like Aether Industries, are you investing for the next cycle or are you investing for the next decade? Because honestly, the answer to that question, it determines everything.